Welcome to Incentives Matter, your guide to what's new in behavioral science and behavioral economics. Let's see what's really driving decisions. Imagine a colossal pot of money, about $18 trillion, just sitting there in bank accounts across the U.S. Now, imagine a significant chunk of the profits generated from that money comes not from clever investments or high-tech algorithms, but from something far simpler: our collective tendency to hit the snooze button on our financial lives.
That's right. The research points to a fascinating dynamic where customer inertia, or what's sometimes called being a sleepy customer, is incredibly valuable to banks. It's not just a minor factor, it's a fundamental pillar of their business model.
Sleepy customers. It sounds almost derogatory, but the implication is huge. Are we talking about a scenario where banks are actively relying on us not paying attention to our savings accounts?
Precisely. The core finding is that banks profit enormously when customers don't move their money, even when significantly better rates are available elsewhere. This inertia allows them to maintain a wide margin between what they earn on those deposits and what they pay out to the account holders.
To really dig into the scale of this, $18 trillion in deposits is a staggering figure. What does that mean in practical terms for how much banks are potentially profiting from this sleepy behavior?
Consider this. If banks are holding $18 trillion in deposits and they can pay customers, say, 0.01% interest on those deposits while lending that money out or investing it at, for example, 2%, that 1.99% difference on $18 trillion adds up to an astronomical sum. Even a small percentage point difference translates into hundreds of billions of dollars in annual profit for the banking sector. The paper illustrates how this differential is not just a rounding error. It's a massive, systematic transfer of wealth from customers to institutions, largely driven by customer inaction.
So a tiny fraction of a percentage point, multiplied by $18 trillion, creates an immense profit center. It's almost like a slow, steady drip that eventually fills an ocean. But why? Why are so many people content to leave their money in accounts earning next to nothing when they could be getting significantly more elsewhere? What's the behavioral explanation here?
That's where the concept of psychological switching costs becomes crucial. It's not necessarily about the actual financial cost of moving money, which is often zero. Instead, it's the perceived hassle, the time commitment, the mental effort, and the fear of making a mistake. People have direct deposits, automated bill payments, and various other financial relationships tied to their current bank. The idea of untangling all of that can feel overwhelming.
It sounds a bit like a gym membership that goes unused. Individuals might know they should cancel it and that they are losing money, but the thought of calling, filling out forms, or dealing with a salesperson is enough to make them just keep paying.
That's an excellent analogy. The perceived effort of switching outweighs the perceived benefit for many individuals, even when the financial gains of switching could be substantial. The set-it-and-forget-it mentality applies very strongly to banking. Once an account is established, it becomes part of the background, a default setting that people rarely revisit. The authors highlight that this psychological friction is a far greater barrier to competition and customer switching than any actual monetary cost.
So it's not just that customers are passive. Banks also seem to have very deliberate strategies to capitalize on or even encourage this inertia. What are some of the ways they actively foster this sleepy customer base? One of the most common strategies is what's known as price discrimination. Banks will often offer very attractive introductory rates or promotional bonuses to new customers to entice them to switch. However, once those customers are onboarded and settled, the rates on their savings accounts or other products will often quietly dwindle down to negligible levels. The bank knows that once a customer has gone through the effort of setting up direct deposit and bill pay, they are unlikely to move again, even if their rate plummets. So new customers get the red carpet treatment, while loyal, long-standing customers are essentially penalized. That seems counterintuitive to how we might expect competition to work, where loyalty is rewarded.
It is counterintuitive, but it's a highly effective business strategy. They're betting on those high psychological switching costs. Beyond promotional rates, banks also create stickiness through bundling. If customers have their checking, savings, mortgage, and credit cards all with the same institution, the perceived difficulty of moving skyrockets. They also don't make the switching process inherently easy. While some online banks have streamlined it, traditional banks often require physical visits, multiple forms, and a degree of bureaucratic friction that acts as a deterrent. This concept of a loyalty penalty is really striking. It is often heard about in other sectors, like insurance or broadband, where the best deals are always for new customers. But to see it so starkly in the banking sector on such a massive scale is quite something. Are there any regulatory efforts to try and shake customers out of this financial slumber or make it easier to switch? Absolutely. In Europe, for example, the PSD2, the Second Payment Services Directive, and open banking initiatives have been instrumental. The core idea is data portability, giving customers the right to share their financial data securely with third-party providers. This makes it significantly easier for new challenger banks or fintech companies to offer services like automated switching tools. These tools can analyze a customer's spending, suggest better deals, and even help migrate their direct debits and standing orders to a new account with minimal effort. The goal is to reduce those psychological switching costs dramatically.
So essentially, they're trying to inject more competition into a market that's been cushioned by customer apathy. How does the US compare in terms of these kinds of regulatory pushes?
The U.S. lags behind somewhat on a comprehensive government-mandated open banking framework. While there are private sector initiatives and companies that offer switching services, it's not as standardized or pervasive as in the UK or parts of Europe. This means the burden of proactive switching largely remains on the individual customer, making inertia a more persistent force in the American banking landscape. The absence of a strong regulatory push towards data portability contributes to the ongoing profitability of banks from customer inaction.
It all comes back to how little many customers know about their own financial situation within these accounts. The research suggests a significant blind spot for individuals. Can you elaborate on that?
The research highlights that a large percentage of people simply don't know the interest rate they're earning on their savings. It's not a metric they actively track or compare. They might pay close attention to their mortgage rate or credit card APR, but savings accounts often fall off the radar. Compounding this, many people are also unaware of the readily available alternatives: online banks, credit unions, or even high-yield savings accounts from traditional institutions that offer significantly better rates than their primary, checking, or legacy savings accounts. This lack of information is another key enabler of bank profitability from inertia.
So, the combination of high psychological switching costs, deliberate bank strategies to make switching difficult, and a general lack of awareness about better options creates this perfect storm where trillions of dollars sit in underperforming accounts.
Precisely. It's a powerful feedback loop. Banks benefit from inertia, so they have little incentive to make switching easier or to prominently advertise their highest rates to existing customers. Customers, in turn, perceive switching as difficult and are often unaware of the financial cost of not switching, thus reinforcing their inertial behavior.
It's a powerful reminder of how behavioral biases can have a significant financial impact, not just for individuals, but across an entire economic sector. So, what are the key takeaways for anyone listening who might be feeling a bit sleepy about their own bank accounts?
First, understanding the loyalty penalty is crucial. Listeners should not assume their current bank is giving them the best deal because they have been with them for years. It's often the opposite. Second, acknowledge the psychological switching costs, but also recognize that the actual effort might be far less than the perceived effort, especially with some of the digital tools now available. Third, a small amount of vigilance, like checking one's savings account interest rate once or twice a year and doing a quick comparison online, can yield significant financial returns.
It sounds like the antidote to the $18 trillion snooze button is a bit of conscious effort and a willingness to challenge the default. For listeners out there, the question becomes, how much is your financial inertia costing you, and what would it take for you to finally hit stop instead of snooze? That's all for this episode of Incentives Matter. Join us next time as we keep unpacking what really drives decisions. Thanks for listening. Choose wisely, or at least know why you didn't.